Good morning, my name's Clive Thompson. This is my little boy, he's 8 years old. I've been investing money for 50 odd years in stocks and other things, and I've made a lot of mistakes, but I don't make as many mistakes as I used to. I'm here to teach you about stocks and investing and how to improve your investment performance from investing in stocks. So today I'm going to talk about 3 of my big stock successes, and right at the end I will tell you about how the same kind of opportunity exists already today in another area and what you can buy to do that, get that 10 bagger. So quite often we have large movements in markets, or something is going on, and this throws up opportunities. Now it can be a crash or a crisis, or it can be a positive thing, and I'm going to give you two crashes and one positive thing which have happened to me in my career where I've made a lot of money, and then I'm going to tell you about something which is positive at the moment where you'll be able to make a lot of money today. So let's start with the 3 stocks which really boosted my portfolio a lot. I'm going to go back to 1997, July. That's 28 years ago, something like that. And we had what was called the Asian currency crisis. What caused the Asian currency crisis? Well, there were many Asian currencies which were pegged to the US dollar. So you had a certain number of Malaysian ringgits, Indonesian rupiah, Hong Kong dollars and other currencies which were at a fixed rate to the US dollar. But as things happened, the interest rate on borrowing dollars was lower than the interest rate for borrowing the domestic currency. So a lot of Asian currencies chose to borrow in US dollars rather than borrowing in their domestic currency, which, despite being fixed, had a higher interest rate. And they saw this as a no-risk strategy, because why would you borrow in the higher interest currency when you can borrow in a lower interest currency, and you can always cover your borrowings at that fixed rate, which is never going to change. Anyway, cut a long story short, interest rates were rising in the United States, and they were rising in the domestic currencies too, but faster. And then one by one, the Asian currencies started to break their link with the dollar. In other words, it wasn't one-to-one anymore. And when the link was broken, the Asian currency would sink in price versus the US dollar. The US dollar was the strong currency. Now don't forget, these companies have borrowed dollars, and that was a big problem because they'd borrowed something which was going up in value, but they were locally based in Malaysia or Indonesia or wherever it was, and it was going to cost them a lot more to repay their loan. In other words, they were losing money on the borrowings as the value of what they'd borrowed went up and up and up. So panic set in, and every company was running to cover their risk by either doing forward contracts or by paying off their loans. But to pay off the loan, they had to sell the domestic currency and buy US dollars. That caused the Asian currencies, all of them, to collapse. And some of them were down 30%. This was not a small fall. But at the same time, people saw that these companies in Asia were facing huge losses due to the rise in the dollar, which was hurting their borrowing. So they were going to book losses on the dollar, and when they did the exchange, it was a realized loss. So as the profits of Asian companies were going to go down, Asian stocks were falling. So out in Asia, we had rapidly falling stock markets and rapidly falling currencies. So I thought it would be a good idea to go hunting in Asia, because when things are cheaper, there might be some bargains. And one of the worst markets was in Indonesia, Jakarta, I suppose. That, I can't remember how much it was down, but it could have been down 30% on the stocks and 30% on the currency. Maybe it was even 70%, I don't remember now, but it was a lot. So I decided to start my hunt in Indonesia, and I ran a filter. I was working in a bank then, and we had some tools, so I could run a filter to see what was interesting in Indonesia. And I downloaded all the big stocks that I could find, looked at their price earnings ratios, their price to sales ratio, whatever information I could find. And I finally settled on one called Metrodata. Now Metrodata was a company which made computers. They didn't sell the computers. They were making computers for a brand named Acer. If you were around and you had a computer back in the 1990s, you might have had an Acer computer too. So anyway, we're talking 1997 here. I bought shares in Metrodata because I liked the multiple. The price earnings ratio was 1, and Metrodata did something very simple for which I thought there would be more demand. They basically took a metal box, shoved in a motherboard, a hard drive, an Intel CPU, and then rigged it all up so that it would, and then they passed it on to Acer, the computer company, which would sell it under the brand name Acer. And I figured this was a reasonably secure business because the demand for computers, as I saw it, was not going to go down. And funny enough, I actually owned an Acer computer as well. That's another way of investing, to look at what you own and maybe buy the companies of what you own, because other people are doing the same thing. But I thought Acer's a brand name, it's well known. Demand for computers is not going to go down. And here we have a company on a price earnings ratio of 1. Now try and find me a company on a price earnings ratio of 1 today. It's basically impossible. If it's on a price earnings ratio of 1, it's going to go bust. That's, in other words, we're looking at the trailing price earnings ratio. The next year's ratio will be negative because the company is obviously in trouble. But in this case, because of the currency crisis, the entire stock market was down a lot. The currency was down a lot, and people were throwing out the baby with the bathwater. They didn't distinguish between the good and the bad. They were selling everything. So in the West, you had many people who were invested in the Asian stock markets, and they were just ringing their bankers and saying, sell all my Asian stocks, or get out of my Asian fund. And so even reputable, well-run investment funds were facing massive redemptions, and they had no choice. They had to sell a bit of everything, and that didn't matter if these stocks were good or bad, they had to sell them. So I bought this company called Metrodata. We're talking 1997, and I sat on it for a year or two, and the price was going up nicely. It was, wasn't very long before the price was double what I'd paid, and I was getting very excited. Even when it's up 30%, you're saying, shall I sell? But the thing was, there were a lot of technology stocks going up at the time, and I was learning a lesson that every time you sell something, it would then go on double within months. So that Metrodata's now, it's at 3 times what I paid. We're talking probably getting into 1999. So the price earnings ratio the earnings haven't changed, but the price has changed. So the price earnings ratio is now, let's say, 3, a P ratio of 3. Still very, very, very cheap. And then something amazing happened. There was a presentation by Metrodata, which you could have found on Bloomberg at the time. I don't think it was on the internet then, but the presentation said that Metrodata wanted to become the biggest internet service provider in Asia. Now, most people didn't even know what the internet was, and those who did certainly didn't know what an internet service provider was, but we had that magic word, internet, and everything with the word internet in it was going to the moon. I mean, maybe go back a few years before that, there was a time when I saw companies who would see their share price double because they now had a web page, because they now had an email address, sales at, I don't know, pepper.com. Getting an email address at one point. Oh, email. Oh, that's the way people used to communicate in the old days. Well, in the old days, we used to send letters in the post with a stamp on them. And then people started to communicate by electronic mail. That's email, electronic mail. And they would send, and you could send a message from one side of the world to the other side of the world in seconds. Of course, now people use other things like WhatsApp and Facebook and God knows what. But email's still used today. But maybe it's dying out in favour of new technologies. But good question. So anyway, companies getting email addresses sometimes saw their price double, but now we're in this dot-com bubble. We're talking now 1999. The share prices of anything technology were doubling, and Metrodata had announced that it was wanting to be the biggest internet service provider in Asia. and the price was going up and up, and it was like four times what I paid. And I said, okay, I've got to sell some. And by the way, I didn't have this rule that I have today, which is sell a bit and then wait and then sell another bit. And I was coming to work every day, and I look at the price and I said, look, I should sell. But I'm trying to resist it, and I managed to resist. And one day I set myself a price. I wouldn't say what it was, but it was, I think it was I think the target price was 40 times what I'd paid. And it was already traded. I said, if it ever drops down, I was trading maybe at 50 times what I paid. I said, if it ever drops down below 40 times what I paid, I'm out, because at least I'll get a profit. But on the other hand, I mustn't sell while it's going up. And then one day I came to work, and there it was at 39 times what I'd paid, and I finally pressed the button. That was probably my biggest gain in percentage terms ever. But what I'm demonstrating to you is when something's going on in the stock markets, have a very close look, because there may be some opportunities which are created by forced selling or by the situation itself, which make prices irrational, and you can buy something really cheaply. Now, just moving on to another situation, the global financial crisis of 2008, 2009 going on. One of the things in the global financial crisis, which was very apparent, debt became a dirty word. Any company with debt was deemed to be a bad thing. So companies were rushing to pay off their debt.
What's a debt?
Good question. So debt is when you owe money to the bank. So companies have borrowed money from the banks. So a bit like the 1997 Asian financial crisis. Companies have borrowed money from the bank, and now they were in trouble. 1998, 1999, companies have borrowed money from the banks. It was a dirty word. They were in trouble. They had to get rid of debt. Shareholders were demanding it. So 1999, it seemed like a very good time to go hunting for companies which didn't have any debt. So once again, I ran some filters, and I found, not only did I find lots of companies which didn't have any debt, I actually found 6 companies which had 0 debt, and even more exciting, they had more cash on the balance sheet than their entire market capitalization. In other words, you could have bought the entire company, stripped out the cash, still be left with a business, and the cash would have paid off what you paid, what you purchased, what you put in. I remember one of the names was a company called Framlington Private Equity, and I looked at that one, and they had a lot of cash on the balance sheet, and they were investing in private equity limited partnerships. So I told my friends about it. They said, "Clive, you're crazy. They're going to take all that money that they've got in cash. They've got it reserved for the commitments they made to the limited partnerships, and it's all going to go into these private equity limited partnerships." By the way, private equity limited partnerships private equity was a bad thing, so it was seemed in that crisis, because they were illiquid. They're going to put all that money into the limited partnerships, and it's then going to be illiquid, and it's not going to be cash. And of course, we all know that private equity is worth 0, they said. Well, I said, well, I'm not sure. Maybe they're not daft, and maybe the people who are running the private equity limited partnerships are not daft. So isn't this crisis going to throw off lots of amazingly low opportunities? So I bought that one. There was another one I bought, which was, I can't remember the name now, but it's a real estate company investing in Indian hotels. And there was another one, a real estate company investing in Russian warehouses. Again, same situation, more cash on the balance sheet than the entire market capitalization of the company. Now, these were very small companies. When I say small, typically below $1 billion. Anyway, long and short of it, one of the companies, so I bought 6 of these, but one of them I bought, which was called Tetragon Financial Services. I think it might have just been called Tetragon at the time. When I looked at the company, they had about $500 million of cash on the balance sheet. They had a portfolio of loans that they had made to other companies worth roughly $1 billion. So we're talking $500 million of cash and $1 billion of loans they'd made. So their assets were $1.5 billion in total. And guess what their market cap was? $100 million. the value of this company was a mere 100 million, despite the fact they had 500 million in cash, no liabilities, and another billion of assets in high yield loans. So I started telling my friends, look at this amazing company, more cash on the balance sheet than the entire market cap. And they said, well, Clive, you're looking at the wrong thing. That was on the 31st of December. We're now in the middle of 2009, even past the middle of 2009, and they probably spent that cash on those rubbish loans, because these were high yield loans. So the kind of business they were doing back then was, when a company wanted to borrow money, let's say Hospital Corporation of America, for example, needs to borrow money, Hospital Corporation of America would go to its bank and say, we want to borrow, I don't know, 10 million or 20 million. And the bank would say, that's fine, we'll lend you 15, provided you borrow from someone else, but subordinated to us, so we have a buffer. So Hospital Corporation would then have to go out and search for another company which would lend them money subordinated, very risky, to the main loan they'd borrowed from Bank of America. And Tetragon was the company which did that type of loan. And they charged whopping great interest, like 15 or 18% on those type of loans, because they were very risky, they were tail end, they were subordinated. But they had $1 billion of these loans. My friend said, you know what, Clive, they're going to take that cash, they've probably already done it, they'll take that cash and throw it into this high yield bond sector, which we all know is going to be worth nothing, because the whole debt world is blowing up. Or everyone with any debt, that debt is, the borrowers won't be able to repay. I said, okay, that could be, but there's still $500 million of cash. It's probably gone. No, I got a bit frustrated, so I rang. The board of directors were in Guernsey, and I managed to get through to them, and I rang them and I said, look, can you explain to me how you, in your last annual report, you had $500 million of cash, $1 billion of this high yield debt, and yet your market cap is only $100 million. Something wrong. Have you thrown away the cash? And I think the reply went something like this: well, Mr. Thompson, we're not stupid. And I said, well, please explain why your market cap is so low. And they said, we'd love to know too. It doesn't make sense. That was enough for me. So I bought it for myself. I bought it for all my clients. So anybody who's my client listening will remember that it's in their portfolio. Many of them still hold that stock today. If you want to have a look at it, you can. You'll find it's still worth a third of the market cap, but it's worth 14 times what we paid as of today. Unfortunately, well, I won't say unfortunately, but yeah, I suppose unfortunately, I sold quite a lot of it along the way as the price rose. I sold, but I am following my 33% rule, which I explained in another video. I've kept part of the position as a memory, and that part I've kept is well above the purchase price. By the way, when I bought this stock, it was paying 3 cents. The price was $1, roughly $1 we paid. It went below $1. It was paying 3 cents a quarter in dividends, which at the time meant that I was buying a stock which had a 12% yield. As far as I know, they never cut the dividend, and they've just simply raised it. And the dividend today is a lot higher than that. I think it's 11 cents a quarter or something like that. But I'm not recommending this stock at the moment or anything like that. It's not supposed to be an investment recommendation. I'm just trying to explain what a good deal that was. So again, we had a crisis. I went looking for something which people didn't want in the crisis. They'd thrown it out, sell everything to do with debt, and because this company invested in debt, it got thrown away by other investors, but it was dirt cheap, and it's made a lot of money for me. And of course, with the bits I've sold, I've got back my original purchase cost many times over. Last one I'd like to talk about is a positive thing which is going in the market, and we're now moving to the middle of 2009. No, not 2009. Sorry, middle of 2020. It would have been around August, I guess, something like that. The price of Bitcoin was rising rapidly. It had gone from $8,000 to $11,000, and it was just relentlessly ticking up. And I felt very, very good about the price of Bitcoin. I was sure it's going higher. It just felt good. And there were two ways to buy Bitcoin. One was to send your money off to strange exchanges on the other side of the planet, which people can do that. There's nothing wrong with that. But I thought might be a good idea to look at which companies are investing in Bitcoin. And I ran some filters, and I found lots of companies which were involved in Bitcoin in one way or another. But one of them I came across was a company which you wouldn't have thought of as a Bitcoin company. It was called Marathon Patent. And according to many websites, Marathon Patent's business was one of buying patents and buying royalty streams, and basically charging other companies royalties to use the patents they owned. Nothing to do with Bitcoin. But there it was. I'd found somewhere an article saying they'd started to buy Bitcoin mining machines. So this was worth looking into. So I went to the website of Marathon Patent and started looking into it. And the more I looked into it, the more I realized they got these announcements one after the other. We're buying more Bitcoin machines, we're buying more Bitcoin machines. And then I started to do some research on Google as to how much a Bitcoin machine could produce in Bitcoins, the electricity cost and things like that. And I came to the conclusion that this company was going to produce, at the present Bitcoin price, and even allowing for the fact that the difficulty of Bitcoin mining goes up, and therefore you mine less Bitcoin every month than the month before, even allowing for that, I could work out that this company was going to make absolutely mammoth profits per share, earnings per share, based on where the Bitcoin mining machines it had ordered. And so I bought the stock, and then it kept making more and more announcements. It's buying more and more machines. The higher the Bitcoin price went, the more machines it bought. I also found another company, maybe a month or two later, called, you may have heard of it, a tiny little company. Nobody knew what it did at the time, but it was called MicroStrategy. They bought some Bitcoin, 23,000 Bitcoin, I think it was, and I think they'd paid about, something like $11,000. And so I bought shares of this company, this tiny little company called MicroStrategy as well, because that was a way to get into Bitcoin through the stock market. There was another one called the Grayscale Bitcoin Trust. I don't know when that came out, but I did own that at one point, but I won't go into that. Anyway, so I had these two stocks, MicroStrategy and what's it called? Marathon Patent. And after a while, in 2021, about a year after I bought it, they changed their name from Marathon Patent to Marathon Digital. It's now quite a well-known company because it's still involved in the Bitcoin space. But what had happened, the share price had risen from something like $4. I paid less than $5. I can't remember what it was I paid exactly, but something like less than $4. By the way, that was 2 to 3 times the price of what the share price had been several months before I bought it. So I didn't put too much money into it. It hurt a lot to pay 3 times what I could have paid, or 2 times what I could have paid 3 or 4 months before. But so I paid, I think, probably an all-time record price when I bought it, but less than $5. But if my maths was right, I was sure it's going to make massive earnings per share. And then, of course, the Bitcoin price was going through the roof. By about March 2021, Bitcoin was up to around $60,000, $60,000. And that's when I sold my Marathon. Now it's called Marathon Digital, making a good 10 times what I put in. So again, what was I doing? I was looking at something where the price was changing rapidly, that was Bitcoin, seeing which companies would be net beneficiaries of that. So now I said I'd tell you about an opportunity today and something I am investing in, and it's not too late. What's changing price rapidly at the moment? Well, the answer is the gold price. The gold price is the best performing asset on the planet probably this year. As I'm doing this, by the way, this video is immemorial. Is time immemorial. You can listen to it tomorrow, next week, next month, next year, forever. It doesn't matter when you listen to it; it's still valid. But we're in the middle of 2025, and I think that we can see that the gold price has got up far more than almost any other asset. So who's the beneficiary of a rising gold price? Well, the answer is the gold mining companies. And the reason is the leverage effect. When a gold mining company is digging the gold out of the ground, if we go back in the past, they were perhaps it cost them $1,500 to dig it out, and they were selling it for maybe $2,000. So they were making a profit of $500 an ounce, selling it for $2,000. Cost of mining $1,500. That's $500 an ounce. But now we're looking at a gold price very close to $3,500. So assuming their cost of mining hasn't changed, and I'll say it will have changed a bit, it's gone up, but let's take the $1,500 cost of mining as is, and we assume that they'll be selling it next year or this year for $3,500. Well, how much profit is that? Well, that's $2,000 of profit per share. So they were making $500 when the price was $2,000, but now the price is $3,500. They're making a profit of $3,500 minus the $1,500 cost. That's a difference of $2,000. They're making $2,000 instead of $500 of profit per ounce of gold. So their profit is 4 times what it was. And that's for a typical company. Of course, there'll be companies which were much more leveraged than what I described. There'll be companies who were hardly digging up the gold at all because their cost of production was $1,999 and their selling price was $2,000, so they're making $1 profit, and now they're making $1,500 profit. So my point is this: gold mining companies right now are net beneficiaries of the rising gold price. And if you look at the gold mining companies, you'll find quite a lot of them have risen in price. Some have risen, they're double, some are 3 times, some are 5 times, and some have barely moved at all. What you want to do is look at the prospects for each of these gold mining companies and what would likely happen to their profits in the event that the gold price stays where it is, compared with what was happening when the gold price a year and a half ago, 2 years ago, was 2,000. And you will discover there are some gold mining companies where the profits are going to be massively higher, many times higher, but the share price isn't yet reflecting that. I'm not going to name the specific companies, but if you want to know, have a list of gold mining companies, go and look at the companies which are in the gold mining index, or you can look at the GDX fact sheet. GDX is the ETF which follows the major gold minings. There's also one called GDXJ, which follows the junior gold miners. They should move more, by the way. And if you look at those, if you look at the fact sheets, you'll find all the gold mining stocks that they hold, and then you can go away and do your study on those individual stocks. And what I'd be looking for is a company which is going to make a large profit next year, 2026, assuming the gold price stays where it is, which didn't make a large profit last year, i.e. 2022 or 2023, and where the share price hasn't moved enough to reflect the difference or the extra rise in that profit in that gold price. So there's your opportunity for today. If you like this video, and if you want to see many more videos that I'm going to do about buying stocks on the stock market and other investments, I might cover bonds, I might cover Bitcoin, I might cover property. There's many things I might cover. If you want to learn about investing, subscribe to this channel and you will get to see all my other videos. Do you have any questions, by the way? Think about that. No questions. Did you understand some of it? Yes. Okay, good. So yeah, subscribe if you like it, to learn more. Obviously you can like, and if you have some questions, I will review all the comments, and I will try to answer all the questions. If I can't answer them all, I'll try and answer most of them. On the previous videos I have managed to answer all of the questions, so please don't hesitate to leave a comment. And if you'd like to get in touch with me with a question, I'm willing to answer questions about investments and financial markets and so forth. If you write to me via LinkedIn, that's another way of getting in touch with me. You'll find me Clive Thompson, Switzerland. I put that in, you should find me on LinkedIn that way, and I'll be happy to answer your questions. I write 2 or 3 articles, by the way, on LinkedIn every week, and you probably find me quite easily just by looking through the recently posted articles. So thanks very much. Thumbs up, like, subscribe and comment. Bye bye now.